Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. With Canada's annual inflation rate cooling, CPI falling to 2.7% in June, and slower growth all around, how will this affect the Bank of Canada's next move? Institutional portfolio manager Ilan Kolet sits down with host Pamela Ritchie and shares his thoughts on interest rates, inflation, and the Canadian dollar. With a consistent cooling down of inflation, Ilan says this could give the BOC the green light to become less restrictive. He says we will probably see a cut real soon, but adds rates will not go back to the historic lows we've seen in the past. He points out that households, especially Canadian households, will still feel the pinch, which will trigger cutbacks on a lot of discretionary spending. Ilan, who previously worked at the Bank of Canada, says the BOC is aware of the stress on Canadians and it has no plans to implode Canadian households. Ilan says what we need to focus on is improving Canadian productivity. Canada's GDP didn't see any growth in 2023 and has lagged greatly behind the U.S. Ilan says currently the Global Asset Allocation team is overweight U.S. equities, specifically in the productivity sector, and underweight Canada. He adds the team is also focused on commodities, including gold, oil, and global natural resources. This podcast was recorded on July 16th, 2024.
Hi, Ilan.
Hi, Pamela.
Lovely to have you here and on this incredible day. Okay, so we have a step down in inflation, which is all the Bank of Canada needs, we presume?
I think so. I mean, again, Inflation Day often feels like my birthday, right? It's like
you love inflation stories.
I don't love inflation, but I certainly feel still a very strong connection to inflation. And I think what we've seen in Canada now on a very consistent basis is a slowing in the rate of inflation. Now, to be clear here, nothing is going for sale, right? So oftentimes when investors think about inflation slowing, they think prices are coming back down to normal. That's not the case. It means that prices are increasing at a slower rate than where they were increasing, right? So inflation is measuring that rate of change. And what we saw this morning with the Canadian inflation CPI print from StatCan, and really what we've seen for successive months, is a consistent slowing in the rate of inflation, which, as you mentioned at the top of the show, this is a green light that's getting greener, I think, for the Bank of Canada.
Right. And I mean, to the point where the restrictiveness of where rates are at 4.7%, 4.75% is probably just too high. Talk to us a little bit about where we are in terms of the rate story. So we've got inflation coming in for this month, and you'll tell us what it is over 3 months, but under 3%. And we've got our rates up at 4.75%. How long can we have that kind of spread?
Yeah, I mean, so what do we know? We know that right now rates are unnecessarily restrictive, right? So what did we see in the last couple of years? We saw a low unemployment rate become an exceptionally high unemployment rate, and now that's normalized. We saw an inflation rate that was quite low become much higher and is now not fully normalized, but almost there. And we have a policy rate, a monetary policy, a Bank of Canada rate that was low and became restrictive and is now almost as restrictive as where it was for some time. So the Bank of Canada doesn't need to be as restrictive going forward as they've been for the last 18 months because of that improvement in the underlying data. But what that means is they'll continue to normalize rates, and you'll notice I'm very carefully not saying easing.
Yeah.
They'll view it as a normalization,
okay,
right, towards a more normal interest rate environment. And they'll do it very cautiously, and in every single statement, they will exhibit that extreme level of caution because, number one, they don't want a resurgence in inflation, and they have to be very careful because we don't actually know where the landing point will be. Right? We don't know what the quote-unquote neutral rate of interest is. If it's 2.5, if it's 3, if it's 3.5. We're sort of feeling around in the dark a little bit on this.
Okay.
And the way to find that is to go very slowly and incrementally.
That said, there will have been some exuberance today from those holding mortgages, and we're concerned about when their renewal was coming up. Lots of Canadians are dealing with that. So let's just go into that exuberance feeling for a little bit and what it means for the economy ultimately.
Yeah, sure. So 60% of outstanding mortgages renew between now and the end of 2026. That's a huge, and that's because the housing market was on fire 2019, 20, and 21. Most of us have 5-year terms on our mortgages. So you add 5 years, you get 24, 25, and 26. I actually screwed up that math on a podcast recently, but I practiced my math.
Yeah, well done. I think that came out beautifully,
So 2024, 25, and 26 is this wave of renewals. And Canadians, pre-COVID, when rates were exceptionally low, they did what low rates incentivize you to do, right? And we've talked about this. They bought not just houses and cottages and condos, right? They bought all sorts of large durable assets, boats and motorcycles and quads, that you financed at a low rate for a long time. Unfortunately, we got the largest inflation shock in 40 years, resulting in 475 basis points of rate increases, which makes the cost of carrying that debt much more stressful. Now, what I would expect is, we've seen 25 basis point cut from the Bank of Canada. We'll probably see another successive 25 in July and more in the future, provided the data continues to come in as it has. But even with the decline and the normalization in rates, we're not going back to the lows that we observed pre-COVID or in COVID. We're just not going back to those historic lows, which means there still will be a proportion of households that are faced with this sort of insurmountable stress, right? And what you'd expect to see is a pullback in discretionary consumer spending to make sure that principal mortgage payment gets made. I mean, Canadians historically, culturally, we don't give back the keys. We cut discretionary spending to the point where you can make that principal mortgage payment. But some of the toys, right? Some of the boats and motorcycles and quads and condos and cottages, they probably go for sale, right? To make sure that principal mortgage payment can get made. The last thing I'd mention there is, the Bank of Canada is well aware of this, right? So I worked at the bank for almost a decade, and so did my colleagues David Tulk and David Wolf. The bank is very well aware of the stress that Canadian households are facing. They have no desire to implode the Canadian household, but if the speculative froth comes out of the condo market, they will shed no tears, right? They will call that a return to affordability.
Okay, interesting, because there are strange things going on in the housing market, which just sort of looks like things are sitting.
Yeah, it's sort of been remarkable. Again, like I joke sometimes that I'm the genius who decided to buy a house in Toronto in 2021. So
you bought a house recently, yeah.
Right, we'll see how that trade works out. But there has been, I don't think we can deny that for the last 20 years there has been a housing-fueled credit boom in Canada. That has had really important and detrimental effect on productivity.
Well, let's talk about that now, because it's a huge story within Canada. It's an incredible relative story.
It's something that we outlined in October of last year.
Yes.
When we wrote a paper called Potential, where we pulled down our cash overweight and deployed that into a US equity overweight, which was done in October of last year. And we made that asset allocation decision because of what we think we're observing in the US, namely a productivity expansion. Productivity expansions will happen 2 or 3 times in our lifetime. They're rare. And
you want to lean in.
And you want to lean in, right? So perhaps artificial intelligence, investments in clean technology, general investment, or sort of blowing up the standard 9 to 5 that we can sort of make optimize our life and work a little bit better. Some combination of those things is boosting the stall speed of the U.S. economy. And for that reason, and again, we just looked at the historical record of productivity. I mean, the U.S. has been a productivity machine, for decades. In Canada, the only place we've really been productive is researching productivity and why it's lagged the U.S. Right? So
you've been doing some of that, actually.
Right. Yeah. So, when I joined the Bank of Canada in 2002, there was a productivity research agenda underway. We've done plenty of research on why there's a productivity gap. Yeah. We don't really have a satisfying answer. But what we thought is, if we are going to be overweight a specific equity sector, this is in October of last year, we think that productivity dividend is more likely to show up in the US than in Canada.
Well, and it's worked incredibly well. If you were to print out all of that productivity work that you did, if you were to print it all out, like what would it look like in here?
Yeah, it would fill this entire office.
We wouldn't be seen on screen. Yeah.
It's a frustrating question, right? Yeah. Because the reason we care about productivity is because it is the single most important ingredient
in growth,
in long-term growth, in boosting standards of living, right? It is that magic ingredient, right? And the way that there are a couple of ways you can boost productivity. You can invest in people, right? You can increase the skill of people. You can give them better tools and the numbers,
so
right?
You've got this sort of immigration story that has lots of pieces to it.
So you can improve the skills of people. You can give them better tools, right? Better capital. You can combine skills and people in a better way. That's like better management. I mean, that's sometimes the hardest one. I mean, that's no comment on my manager, but that's sometimes the hardest one. And I think one thing that's happened in Canada, and again, this is something we've discussed and written about, is the housing and credit boom in Canada for the last 20 years has diverted capital away from productive investment, right? Starting businesses or building new plant and property, opening businesses, into unproductive capital. And housing is a great example of unproductive capital.
So higher interest rates should change that.
That's the optimistic view, right?
It should.
Right.
I mean, whether it will.
Yeah, I mean, unfortunately, excessively low interest rates for a long period of time had knock-on effects or externalities, which in Canada, the most obvious one is this housing and credit boom, right? And we'll be researching the negative effects of low rates for the next 100 years. To me, the most obvious one in Canada has been a speculative housing boom and a credit boom, as well as the diversion of capital away from opening a business into, why would I open a coffee shop if I can just buy a condo assignment, a piece of paper, and flip it every year for 10% return?
Or even just rent it.
Or even just rent
whatever
it. Right?
That's.
I mean, a condo assignment is not even a condo; it's just a piece of paper, right? So, or an email. So, I mean, this has had a damaging effect on Canada in terms of its relative growth with the U.S., both in the short run, but also in the long run. I mean, you might argue that the more damaging impact is not just the short run gap in growth. And Canada's economy didn't grow at all last year in 2023, and our research team thinks that we were actually in a recession last year. But the longer term prospects are even more troubling. The one thing I would add there, though, and a potential silver lining for Canada, is immigration, right? So, and this is a bit of a double-edged sword. In the medium to long run, immigration is a boost to growth, right? So the way that the two ways that you can increase output in an economy is you can become more productive, which we're not very good at, or you can increase the number of people, right? So you can make
working and paying taxes and doing things for the economy.
Exactly. So you can make the production line more efficient with a better machine, or you can put more people into the factory on the production line.
Can we do both?
You can do both.
We've got the AI boom, isn't that the whole idea?
Right.
Yeah.
And so we haven't done the first one very well, but the second one, increasing the number of workers to provide supply in the economy, could be a boost in the medium to long run. But you'll notice I said very intentionally medium to long run.
Not tomorrow.
Not tomorrow, because skills take time to be absorbed, and oftentimes there's a really serious mismatch of skills, right? The engineer that's sort of driving an Uber, right? I mean, we all have these stories.
Sure.
So in the short run, unfortunately, there's that skills mismatch, and it also shows up as excessive demand.
I want to just shift back to what Tiff Macklin, his team at the Bank of Canada, will be doing next week, whether it will indeed be a cut. Markets certainly think so. It sounds like you think so. Tell us a little bit about the monetary policy story and lags and what we need to know there. I mean, there were some that will even argue, depending on what, if it's 18 months for a hike to kick in or whatever, that we're still absorbing the hikes in some ways. So then down the other side, just give us some perspective on what we can expect. There's the catalyst story of a cut in an equity market, but what about the economy?
This is a question that sort of tortured us for some time. We saw 475 basis points of hikes in Canada, 525 in the US.
It's a lot.
Is this recession avoided or recession delayed? We gained conviction in the US that actually this is recession avoided because household debt levels are lower than they were, pre-crisis. We might be in the midst of a potential or productivity boom. And the soft landing looks to be the base case in the US. In Canada, it's a bit of a different story here. In Canada, household leverage is much higher, right? So servicing that debt is much more painful. Again, we haven't had any growth. Canada economy did not grow at all in 2023. StatCan may tell us next year, oh, by the way, in 2023,
we'll revise it.
We were in a recession. StatScan's very good at forecasting the past.
Yeah.
But we don't.
Hallelujah.
We don't have that luxury as investors. In terms of the lags, when I was at the bank, the standard phrase was, the monetary policy lag is 12 to 18 months. But I think it's much shorter than that
You
today.
do, right?
I do.
Okay, that's the sort of what I wanted to ask you.
I think it's much shorter. I don't
You
think
it kicks in?
I think it kicks in much sooner because, agents in the economy or households are sooner to adjust. So for example, prices go up a lot, suddenly, and your mortgage payment has gone up a lot. You're seeing that and feeling that almost in real time, right? At the end, you're seeing that when you log into your bank in real time, and you're saying, well, I'm paying $100 for the gym every month. I haven't gone in years. I can cut that now, right?
Yeah.
Or Netflix.
You're making discretionary decisions much faster than 12 to 18 months.
I think so. I think much faster. And I mean, on one hand, it's good because that adjustment gets front-loaded and gets brought in quickly. But the other side of that is that wave of renewals just keeps coming.
So with all of the pieces that you've outlined here and the pieces that you do know and the things that we're still waiting for on sort of how the economy goes from here, how is your positioning evolving? Your position is always evolving.
It is.
And you've outlined what you've done with U.S. equities and leaning into that productivity cycle in the U.S. Give us a bit of an update.
Sure. So
to the extent you can.
Absolutely, yeah. So the first thing to note is we're overweight equities.
Yeah.
Right? So in our 60-40 global balance portfolio, which we kind of use as an example, right? That's a globally diversified 60-40 portfolio with fantastic managers that we've chosen, many of whom you speak to regularly. We're slightly overweight equities, right? So right now that 60-40 is rough.
About 60?
Is about a 65-35.
Okay.
Right? You might 64-36. So modestly overweight equities. The range on that portfolio is plus or minus 15%.
Okay.
So that 60-40 can be a 75-25 or a 45-55. Right now we're modestly tilted into equities, and that's really principally in a couple of spots. Number one, the US.
Great.
Right, so we are optimistic on the US. We're overweight US equities because of that discussion that we just outlined, that productivity, that pulling away of the US economy.
Yep.
The other place is we have a kind of a meaningful overweight to commodities right now.
Okay.
That's gold, that's oil, that's also global natural resources, an underlying fund here in Canada. And we're cautious on Canada. So we're underweight Canadian equities. That's because of that lag that we expect to see in Canadian equities. There is a really important clarifying point there. I think sometimes in the past, if I had to give myself sort of a self-evaluation, when I've said that...
It's very mature of you to do that.
Yes.
It's very mature of you.
I think they asked me to do that. But I sometimes, when we talk about that underweight to Canadian equities, viewers or advisors think they don't own any Canadian equities and they are wishing for a Canadian implosion. That's not the case. What I'm talking about when I say we're overweight the US and overweight commodities and underweight Canada, 21% of the equity side of that fund
It's where you're in there.
are Canadian equities. We're trimming that by say 5 or 6%, right, down to 15. So we just believe two things. One, the US and say commodities are going to outperform Canada. So let's move more of the allocation into those buckets. But the second thing to note is we have fantastic managers, underlying managers in Canada, right? So the Marks and the Hugos and the Dans and the Andrew Marchese's that you speak to regularly, if they win against their benchmarks and we own them, they boost the performance of our fund, which they've absolutely done.
Is it a call on inflation going up?
Originally, when we had an allocation towards commodities, well, let me back up. We thought inflation was going to push higher several years ago, and we allocated towards commodities and TIPS. The TIPS being the fixed income instrument that prices to non-seasonally adjusted CPI in the US. I won't even pretend to say that we expected to see the inflation rates that we saw. There's no world in which I expected 8 and 9% inflation. But we owned the asset classes that historically have provided that protection in portfolios to inflation. I would say the motivation now for adding to commodities is slightly different. I don't think we're out of the woods on inflation. There's still some inflation that we need to battle. I mean, I think one of the motivations for that sort of increased commodity exposure is the more protectionist world that we're in now.
Sort of a deglobalized world type piece.
Exactly.
Yeah.
And potentially, we'll see what happens in November, a more protectionist world even after that.
Yeah.
Right? So, without beating around the bush, a more, tariffs
For sure.
result in inflation, right? And I think we can be head on about that. And if that's the world that we're going to be living in, where there's more tariffs and more inflation, we want to own the asset classes that protect the funds and the investors against that.
Is total productivity more important, Ilan, than per capita productivity, for instance? So just get some insight.
Here, I wouldn't slice it necessarily that fine.
Okay.
So I think the way I think about that question is productivity is absolutely the most important ingredient into long-term growth.
Right.
And total factor productivity meaning not just the labor, not just the capital, but the combination of the two. That really is the special sauce. The per capita question is an interesting one, right? So, if I mentioned GDP growth in Canada was a flat line GDP, the level of GDP in Canada was a flat line for 2023, meaning the size of Canada's economy did not grow at all in 2023. Right. In per capita terms, that's a fairly steep line down. And the reason for that is the enormous surge in inflation, in immigration rather,
Yes.
in population, right? So the way I view immigration is in the medium to long run, this is an undoubted positive. My parents immigrated to Canada in the early 70s, like a lot of people did, exactly. And in the medium to long run, skills get matched better and resources get allocated to the right buckets, right? Yeah. I mean, that's the way I think about it is as resources. In the short run, it's a bit painful, as we've observed, right?
Absolutely.
Right.
Absolutely.
So it means much more demand for an economy that is just coming back online to supply the economy, but needs even more supply, right? Which
Absolutely.
is, I think this is one of the reasons why the Canadian housing market, a lot of people viewed as resilient. It wasn't really resilience, it was just a tremendous increase in demand.
I want to get into the dollar. This is the US dollar vis-a-vis the Canadian. It fits into some of the story of certainly the overweight to US equities that you were talking about. But also, I want to sort of flesh out the other side of the managed portfolios, what you've got in the 40 and how that's different. But can we go to the dollar first? Because it speaks to the US equity overweight, or part of it anyway.
Yeah, absolutely.
Where's this dollar going? The US dollar, where's it going now? Changed 48 hours ago for some people. I don't know.
So there are a huge amount of questions within this that I think are worth digging into. The first question really is, how do we use the currency in our portfolios?
Great.
So the Canadian dollar is a cyclical currency, meaning in periods of stress, we get depreciations, right? So think March 2020, which none of us want to think about, but March 2020, right? Onset of COVID, risk assets are in free fall and the Canadian dollar depreciates. Think back half of 2022, right? Even with Russia invaded Ukraine, $100 oil, we see a move in the Canadian dollar from 82 cents to 72 cents because of that risk-off sentiment. So this underperformance in Canadian assets that we're expecting, or this relative outperformance in other parts of the world, or the stress for households in terms of renewing mortgages and carrying debt, one of the first valves or levers to be released would be a depreciation of the Canadian dollar.
Okay.
Right, so we certainly believe the direction of travel is down and is a depreciation, and it's one of the reasons why we have a large and sizable underweight to the Canadian dollar, is because in the event of that depreciation, so the Canadian dollar depreciates and we have an underweight, our portfolios get hurt less. This is, in 2022, this is one of the few ways we were able to preserve basis points and do better than our peers.
Interesting.
The second point, though, which I think was your actual question, is, what are the factors that we think about in terms of determining the value of the Canada-US exchange rate? And here I think there are three. Okay. And I didn't come up with these three. This is a model we used at the Bank of Canada 20 years ago. I'm sure they're still using it today. The first one, which is front and center right now, is called the interest rate differential. Right. Meaning the Bank of Canada is easing, the Fed is sort of staying pat for now. That gap is widening, right? Interest rates are lower in Canada than they are in the US. Higher interest rates in the US, capital inflow into the US bids up the US dollar. That's a downward arrow for the Canadian dollar. So that's a downward arrow. The second one, which we just discussed, is sentiment.
Yes.
Right? Sentiment weighs very heavily on the Canadian dollar. And the third one we still have on the list, but we can kind of cross off, is commodity prices or oil prices. Oil at $100 in 2022 with Russia's invasion of Ukraine We should have had a much stronger Canadian dollar. We didn't because of this really significant decoupling. And this decoupling is fairly recent. I mean, it's a lock. This relationship is a lock for many years. It was an important part of that model at the Bank of Canada, and it's decoupled. This is another, sometimes the question is raised as, aren't oil and commodities a tailwind for Canada? And the answer is yes, but less. And that's because of a 50% decline in oil cutbacks since 2014, which means less of a tailwind and less of an influence on the value of the Canadian dollar.
It's fascinating how you invest that. I would like to just ask on the other side, in terms of positioning, so you've spoken to sort of the equity side and in the amount, a modest overweight. On the other side, bonds, alts, what else?
Yes, actually alts is the one for us to really focus in on.
Let's do that.
This is fairly new. I mean, you've probably spoken to my colleagues about this.
A few times, yeah.
In the middle of May, we added an allocation to 3 Fidelity Canada liquid alternatives. I'd encourage everyone to seek out our Q2 thought leadership paper, which really gets into the details and describes the details of this allocation. It's a very small allocation, but it was an important one because of a few things. One, our research suggests it could improve the risk-adjusted return of the managed portfolios. And in the case of the private investment pools, our partnership with Brookfield is a fantastic way to hedge inflation risk. This is all described again in the paper. But I think one of the most interesting things to note is for generations, for decades, alternative investments were only accessible to large institutional investors, family offices, sovereign wealth funds. And now, and this is very Fidelity DNA, we've sort of begun the democratization of alternative investments in the managed portfolios and the private investment pools.
What's your general outlook on inflation, both in Canada and the US, over the next 2 to 5 years? So we've talked around that. Maybe just give it a specific.
Yeah, sure. So we're moving in the right direction, certainly in Canada, and now again in the US. In the US, started this year, we had some temporary factors that were keeping inflation elevated. I think we will continue to see progress on inflation, but getting back to 2.00 is going to take some time, right? Okay. It's going to take some time because of the lift that service inflation is providing to underlying inflation baskets in developing economies. We're going to get there. This is going to be a little bit sticky along the way, but lots of progress. There's been lots of progress.
And the managed portfolios are invested for that journey.
Exactly.
Okay.
Yeah. So we always want to own the insurance against the risk, with that risk being our main concern.
Thank you for bringing the story of how you see things unfolding and the investments therein. Ilan Kolet, thanks for joining us.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.